So today I want to talk about what we do as a company when we're looking for apartments, how we're trying to help our investors. So we find that the important things to investors include, number one, preservation of capital. Number two, they want to see their investment grow, certainly faster than inflation. So we're looking for a good return on their investment to satisfy that. And now I'm speaking generally about most of the investors that we see. They want to see equity growth that's reasonable and will improve their overall availability of funds over a period of time. So that's reasonable growth. And we try to solve those problems for our investors. Tying that into looking at apartment complexes. So we've got to identify a couple of different things. One is what we can view as, for lack of a better term, false appreciation. So just like with single family houses, when interest rates come down, the price of houses you generally see will go up. Well, that's pretty much something that you'll see with apartment complexes as well. As your interest rate goes down, you're going to find that people are going to try to get more money for their apartments, and you're going to find some people that buy at that higher price. The problem with that is you're reducing the capitalization rate, the cap rate. So if I'm in an area that's normally, let's say, a 7 cap, and because of the things, and there are other market factors, but things like a lower interest rate for mortgages, those rates go down, I may find that people are going to get more money for their apartment complex. So that will drive the cap rate, let's say, from a 6 to a 5. But it's kind of a false appreciation because you're not improving the net operating income, which is generally the driving factor for cap rates and appreciation value. So let's say we've got that same apartment complex. Now the interest rates are down to, let's say, 4%. The prices tend to go up. We have somebody that jumps in and buys at that higher price. Their plan is to either sell or refinance within a 5-year period. Now, they haven't been able to do anything to improve the property and drive rents up or lower expenses, which would change the net operating income and the dynamics with the cap rate. So let's say in 5 years they go to refinance. Now all of a sudden there's no 4% interest rate. It's up to 6 or 6.5. But they haven't changed their net operating income. You know, the factors between income and expenses have stayed the same to give you the same net operating income. Now when you're calculating the cap rate relative to the market, you haven't driven up the value of the property. You have not successfully improved the value of the property through the normal commercial calculations. So you haven't done any true appreciation of that property. That fake appreciation that was there because you had those low interest rates has now disappeared. You haven't done anything to improve the property. Now you're not going to get that price you thought you would get 5 years earlier when you're coming down 5 years down the road. So we are very careful when we look at these factors when we go out to purchase an apartment complex. We're aware of factors that can affect the cap rate and the value of a complex, and we're very much aware of what we have to do to increase the value in the true sense, increase the value of that complex, which is increasing the net operating income by either driving up the revenue or reducing the expenses, or the combination of the two. So I hope you've enjoyed this. I hope you understood what I was trying to say. And our biggest criteria is to preserve the capital of our investors, give them a solid return that can beat inflation, and that's what we look for. So thank you for watching, and I'll talk to you again soon. Have a good day.